Welcome back to another episode of Not Financial Advice. My name is Sean. Today is Monday, January 29th, and today we're going to be taking a look at Google stock. And by the end of the video, we're going to figure out a fair value estimate per share for Google. We're going to get started by taking a look at how my portfolio is doing today, and then we're going to dive into the topic of today's video right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, thanks for joining me. I'll ask you to like the video and subscribe to the channel. Let's start with a quick update on how my portfolio is doing today. Here at Not Financial Advice, you're able to see 100% of my investments 100% of the time, not only on green days like today, but also on the red ones as well. And as always, if there's a stock or an ETF that you'd like for me to review, I'd be more than happy to make a video on that just for you. So leave its ticker symbol in the comments below. But let's get started right now. So at the moment, my portfolio is sitting at $69,700, up 0.53% today. Today, my top performing position is Coinbase, up 5.8%. Cannabis company Trulieve is up 4.9%, Tesla 3.7%, Domino's 3%, Ulta Beauty up 2.85%. So a pretty broad day for the market. Some risk type assets, consumer discretionary, as well as consumer defensive leading the day. Let's take a look at the bottom 5 decliners. I have a pretty diversified portfolio here, so I can usually get my finger on the pulse of what's moving the market just by looking at my own holdings. So the bottom 5 decliners today are going to be Target down 1%. Green Thumb Industries down 1.3. Also down 1.3 is Walgreens. Down 1.8 is Best Buy, and down 2.8 is Williams Sonoma. So not really seeing a rhyme or a reason to this, but as it sits, portfolio is doing quite nicely at an all-time high of $69,700. So let's get into today's topic of the video. Like and subscribe to the channel. And what we're going to be doing is taking a look at shares of Alphabet, ticker symbol GOOG or GOOGL. So the stock is up 0.7% today. Earnings for Google are out tomorrow. And so we're not going to be making a prediction on how the earnings are going to go, but we are going to be giving a fair value estimate of what Google's worth per share. Zooming out over the all-time chart, we can see this stock is up a lot over all times. Looks like this company or this particular share class became a thing in about exactly 10 years ago, and it's up 454%, so up about 45% a year, which is nuts. And so you can also see here in the bear market of 2020, the stock went down as much as 41%. I did do a good amount of buying sort of in this range here, but it was volatile enough to go down 41% on a mega cap technology blue chip type stock. Since that time, it's recovered 75%. And to sort of frame the topic of today's discussion, my question is this: is growth the new value? And so we're going to explain what I mean by that after we go over the pros and cons of this potential investment and the things that I keep in mind as I hold this stock myself, which I do. So for Google, some pros is it has a wide moat. YouTube, the platform you're viewing this on, has more streaming hours than Netflix, and I believe every other streamer combined. So AI integrations definitely could improve revenue. And this isn't 2021 anymore. So innovation is happening now. The future is now. I already see as I go into Google Docs that they're giving some prompts with some different AI type products. Obviously, you have AI's chatbot, which was a couple months late to the game after ChatGPT. When you make searches on Google, you get prompts for AI large language model. So all these different things can definitely be monetized moving forward, growing their core business, which is search, essentially advertising. That's what this company is all about. So more pros for Google. We could see growth for the Google Cloud platform, which is the number 3 cloud provider with Amazon AWS in the first spot internationally, Microsoft Azure is in second place, and with the least cool name, Google Cloud Platforms is in third place. So if they jump to second place, that could be a lot of revenue and a lot of gains. So cons on this potential investment, there's always a risk of antitrust lawsuits from the federal government or from European regulatory agencies. There is competition in cloud, which should be a high margin business. Not necessarily sure if it's as high margin for Google as it is Amazon. I don't think so. But you could see more competition in search. Microsoft's, I think gone from 1% to 3% in a year because of Chat GPT. So you could see some pressure on advertising on the search front. There's a question about limited growth possibilities for the future, and sort of a bear case thing with growth stocks, and those are people who would value stocks more. But that's sort of a topic we're going to be discussing here. Is what is the growth prospects for Google? Is this a company that could be owned by value investors? I consider myself one, and I own it. So, a little spoiler alert there. Some more cons for the investment is the PE valuation. Can this thing trade at a 30 PE and still be worth it? It's trading about 23 right now, but that's historically higher than average for the stock market. But some of these mega cap tech companies have exceptional balance sheets. In many cases, I think it might be worth it. And then lastly, there could be a decline in demand for advertising revenue based on a potential recession. So, like the video, subscribe to the channel. I'm going to do a read through real fast. How does Google make money? That was the search query. So, Alphabet, also known as Google, is a collection of different companies, including the popular search engine Google. The company leverages its search, web browsing, mobile operating systems, and cloud computing to make money through the sale of advertising and various service fees. Google advertising generates the majority of revenue, but Google Cloud revenues are growing rapidly. The company has three reportable segments: Google Search, Google Cloud, and Other Bets, which they recently announced they're going to be cutting down on their losing segment of Other Bets, where they're just doing weird, far-flung tech stuff. Google Services is the most profitable, while Google Cloud and Other Bets often post operating losses. That might be a little bit of a broad brushstroke, but we'll take it for what it's worth. So now we're over here on Qualtrum. It's a suite of software that I pay for to look at stocks, not one I'm affiliated with. So I'll leave the link for Qualtrum in the description below. But let's take a look at Google over here on Qualtrum and sort of dive into some high-level metrics as well as their balance sheet. So trading at a forward PE of 23. Free cash flow yield of 2.9%. This is going to be a nearly $2 trillion market cap company, making it a mega tech, also part of the Magnificent Seven, formerly known as FANG. And let's take a look at Google's revenue for our check marks and minuses. So revenue looks great. This chart looks fantastic, up 17% a year for the last 10 years. In the last 5 years, that growth has slowed to 15.6%. And then in the last 2 years, just 4.8. But looking sort of between these numbers, and also with some of my research, I think we could project revenue growth of around 10% for the foreseeable future. So that's the number we're going to be using in our rough DCF estimate of the fair value of Google stock. So great growth on Google, check mark. Okay, so now let's move on to our next metric. So let's look at free cash flow. We're going to look at their free cash flow minus the stock they give executives. And so over the last 10 years, free cash flow is up 17.7%. In the last 5 years, free cash flow is growing. So the company is becoming more profitable. Even as revenue starts to slow, their profitability is accelerating. That's a good sign. So this will be a massive check mark on free cash flow growth for Google. And now we move on to our next metric, which is going to be earnings per share. Free cash flow is the ultimate long-term determination of the value of a stock, but earnings per share can definitely predict the price movement in a shorter or intermediate time period. And looking at the EPS on Google, up 17% on average over the last 10 years. In the last 5 years, up about 16%. This number looks more similar to their revenue growth rates as opposed to their free cash flow, which is jackknifing up and to the right. So for EPS growth, Google is another check mark. Now we're going to take a look at cash and debt. So they've got a lot more cash than they do debt. Is growth the new value? I don't know, but on cash and debt, Google earns another green check mark. So looking at shares outstanding, let's take a peek under the hood. Google is buying back shares, so just moderately, mildly, if you will, down 1.33% a year over the last 5 years. That's pretty good. So the stock price is pretty high as well, but this looks really appropriate. This is just going to be another check mark for Google. So everything's in the clear. Let's see if we can find anything that we don't like about Google. So looking at returns on capital employed for Google over the last 10 years, it looks like a median number would be somewhere around 16%, which is really good for such a huge company. So we're going to have a big check mark for Google. And also note that their returns on capital employed are spiking here in the last 2 years, which is certainly a great sign. Let's take a look at their bottom line profit margin of a lot. About 23% seems to be the median. 22% or so. Looks really good. Big check mark for Google. So now we have to see the where they rank up on historical PE valuation for this company. And so it looks like they're actually trading at a discount to their historical PE ratio. Another check mark. And although they do have high returns on capital employed, their expenses are going up and to the right for Google. So this will be an X, just, keep things fair. Their expenses are going up. At the same time, their free cash flow is going up, and so is their other metrics, whatever I was going to say. So yeah, that looks good. Their free cash flow per share is going up, revenue's going up. So I'll give it a red X, but everything's looking good. The only problem when you see all these green check marks is going to be the valuation. So the stock is currently trading at $155. Let's see if we can get an estimate of what this company's worth on a per share basis. I'm going to pull that up now. So what we can see here is all the data I've inputted from Qualtrim, as well as my own assumptions about the future growth on the company. And so we have an average on free cash flow over the last 5 years of $31.1 billion a year, which is an astronomical amount of money. Looks like they have this amount of cash. I think this is 119 119 billion, 14 billion or so in debt. They have 12.7 billion shares outstanding. I've done a projected growth rate of about 10.25% over the next 10 years, a terminal growth rate of 3%, and a discount rate of the terminal growth rate is 3%, discount rate is 10%. $155 stock based on a free cash flow DCF, the value of this $155 stock would be $70. But that doesn't really tell the whole picture or show the whole story. So let's also see what we get for a fair value estimate based on earnings per share multiple. So using an earnings per share multiple valuation, this is the total number of a total dollar amount of earnings per share over the last 4 quarters for Google. This method also uses a historical median PE. I've put a growth rate on EPS of 12.5% without a margin or safety or growth decline rate and a 10% discount rate. So $155 stock value we see here, $146. So taking a look at Google's valuation, not only based on earnings per share multiple, but also based on a free cash flow valuation metric, the average that we get to is $108. So I'll leave this video with a Peter Lynch quote, sort of along that same line of questioning: is growth the new value? So Peter Lynch said, stocks are more of an art than a science, and people who uh, look at things in a very rigid framework can be at a disadvantage. So I think the fair value of Alphabet is approximately around $108, give or take 15%. And so at the same time, started in early 2021. Uh, it probably would have shown that it was overvalued at that time as well. And so just based on their very high bottom line margin, based on their uh, high returns on capital and high returns on equity, and sort of the wide moat of this company. I think it often trades at a premium. And while I think the value is around $108, I was certainly happy to be buying it here in this range from 108 to 108. That was a window of 6, 7 months. And so valuation does matter at the same time. And so am I saying that if I were to buy more shares in Google today, I wouldn't make money in 5 to 10 years? No, I don't believe that. But to get those really outside returns, valuation does matter, because this is a widely covered stock and markets are mostly efficient, but not all the time. So was the market efficient when they discounted Google by 40%? No, the market was wrong. I was right. And that's that. So, as always, if there's a stock or an ETF you'd like for me to take a look at, do a review on, just leave the ticker symbol in the comment below. I'd be more than happy to make a video just for you. On your way out, make sure to hit like and subscribe, and I will see you on the next one.